Welcome to the deep dive. We take all that information swirling around and really try to boil it down to the key insights, helping you get up to speed fast.
That's the goal. And today, we're diving into a pretty significant piece of financial info.
We are. It's the latest quarterly report from Core Natural Resources, Inc. We're looking at the quarter that ended March 31st, 2025.
Right. And, whether you're someone who follows the energy sector closely, or maybe you're just interested in seeing how a big merger actually affects a company on the ground.
Or maybe just curious about the finances of a large corporation.
Exactly. This deep dive should help. We'll cut through the noise and pull out what really matters from this report.
Okay, so the source itself, it's their Form 10Q filed with the SEC.
Think of it like a quarterly checkup for a public company. Gives you the financial statements, management's view on things, lots of important details.
A real snapshot.
Yeah, and our mission really is to sift through this 10Q and highlight the most important financial and operational points, especially focusing on where Core stands now after that huge merger they just completed with Arch Resources.
Okay, let's start right there then. The merger. That closed, what, mid-January 2025?
January 14th, yeah. It was structured as an all-stock merger of equals.
Meaning Core issued a lot of new shares, looks like about 24.3 million?
That's right, which works out to roughly 45% of their total shares outstanding after the deal. And the deal value itself, based on the stock price then, was around $2.48 billion. Big numbers.
Huge. And you see the impact immediately in the revenue. Right?
Oh, absolutely.
Right.
First thing that jumps out, for Q1 2025, their consolidated revenue was just over $1 billion, $1,017.4 million.
Compared to what, about $547 million the year before?
Exactly. $546.7 million in Q1 2024. So yeah, it basically doubled. And that's largely down to adding Arch's operations. Their sales volume in tons also shot up by nearly 14 million tons.
And it wasn't just more thermal coal, was it? This fundamentally shifted their market position.
That's a key point. They gained a really significant presence in the metallurgical coal market.
Met coal, the kind used for making steel.
Right. They got mines in West Virginia, producing that premium stuff for the global steel industry.
Yeah.
That diversifies their business quite a bit.
Gives them exposure to different economic cycles than just power generation.
Precisely. Plus, they also acquired thermal surface mines out in Wyoming and the Powder River Basin, the PRB, and a high-quality thermal longwall mine in Colorado, too. So broader geographical and product reach.
Now, integrating two giants like this obviously costs money. The report calls out, was it nearly $50 million in merger costs?
Yeah, $49.2 million just in this first quarter alone. That's pretty substantial.
Covers things like banking fees, legal costs, integration planning.
All of that. It's typical for a deal this size. And something else to keep in mind is the purchase price allocation. Assigning value to all of Arch's assets and liabilities they took on.
Right.
That process isn't totally finished yet. They say it's preliminary. So as they get final appraisals, the book values for mineral reserves, property, equipment, all that stuff could still change.
Okay, so messy first quarter in some ways. Let's pivot to the overall financial performance then. Q1 2025 versus Q1 2024. This is where it gets, well, interesting.
It does. Because despite that massive revenue jump we talked about, the bottom line swung the other way.
From profit to loss.
Yeah. They reported a net loss of $69.3 million for Q1 this year. Compare that to Q1 last year when they had a net income of $101.9 million.
So the big question is why? More revenue, but a loss.
Well, part of the answer is in the costs. If you look at the revenue breakdown, yes, they've got new income streams from met coal and more export sales.
But the cost of getting that revenue also ballooned.
Exactly. Cost of sales jumped from $354 million last year to over $870 million this year.
Wow.
And depreciation, depletion, and amortization DD&A that nearly doubled too, went from $57 million to about $121.6 million.
And a lot of that is just bringing Arch's much larger operations and asset base onto the books, right?
That's the main driver, yes. Incorporating all those new mines, equipment, reserves, it increases both the direct costs of production and the non-cash charges like DD&A, plus those merger costs we mentioned.
Which all flows down to the earnings per share, or in this case, loss per share.
Right. For Q1 2025, it was a loss of $1.38 per share, both basic and diluted.
Compared to earnings of, what, $3.40 basic, $3.39 diluted last year. Big swing.
It is. And just a small technical point, the reason basic and diluted loss per share are the same here.
Right, because when there's a loss, things like stock options don't dilute it further. They actually make the loss less bad on a per-share basis, so you don't count them.
Exactly. Anti-dilutive, they call it.
Okay, so a complex picture on the income statement. How about their financial stability? Liquidity, especially after spending cash on the merger integration.
That's a good question. And actually, their liquidity looks pretty solid. As of March 31st, they reported total liquidity of $858 million.
And that includes cash plus available credit lines.
Yeah, it's their cash and equivalents plus what they could draw down from their accounts, receivable securitization programs, and their main revolving credit facility netting out any letters of credit they had outstanding.
So, a decent safety net.
Seems like it. And they actually improved their main credit facility in January alongside the merger. They bumped up the total capacity to $600 million, pushed the maturity date out to 2029.
And got better interest terms, too.
Yeah, reduced the interest margin, which is good. As of the quarter end, they hadn't actually borrowed any cash against it, though they did have about $185 million tied up in letters of credit.
Which are like guarantees, often for things like reclamation bonds or supply contracts.
Exactly. Standard practice. They also have those securitization facilities, basically borrowing against money customers owe them.
Looks like two separate ones now. One legacy console, one legacy arch.
Right. Capacities of $100 million and $150 million. But it's worth noting those mature pretty soon, July and August 2025.
So they'll likely need to renew or replace those later this year.
You'd expect so, yeah.
Yeah.
It's part of managing their working capital. Another thing they're doing with capital is buying back stock.
Yes, the share repurchase program. $1 billion authorized in February.
That's the one. And in Q1, they spent about $101 million to buy back roughly 1.4 million shares.
Returning cash to shareholders, potentially boosting the share price. And they're paying a dividend, too.
They are. Declared $0.10 per share just recently, in May. Though, like most companies with significant debt, their ability to pay dividends is usually subject to certain conditions in their loan agreements.
Standard covenants, yeah. Okay, let's shift gears a bit. How are the different parts of the business actually performing? The segments.
Okay, so the report breaks it down into a few key areas. You've got high CV thermal, that's their high-quality thermal coal, mainly Pennsylvania, West Virginia, Colorado.
Then the new metallurgical segment we talked about from the Arch deal, mostly West Virginia.
Right. Then the PRB segment for the Powder River Basin mines in Wyoming. And finally, the Baltimore Marine Terminal for exports, plus a small other category.
And looking at Q1, where did the revenue and, say, adjusted EBITDA come from mainly?
Well, not surprisingly, given the merger, the high CV thermal and the metallurgical segments were the big engines for both revenue and adjusted EBITDA.
Adjusted EBITDA being that measure of operating profit before interest, taxes, depreciation, amortization.
Correct. It gives you a sense of the core operating performance. And those two segments really drove it in Q1.
What about the PRB segment? That region's been facing headwinds for a while.
Yeah, the report acknowledges that. They mentioned they are strategically managing what they call a shrinking operational footprint there. Basically, as U.S. power plants switch away from coal, they're planning for the eventual wind down and reclamation of those mines.
A managed decline, essentially.
It seems that way. It's a reality many thermal coal producers in the U.S. are dealing with.
Okay. Now, every financial report comes with warnings, risks, forward-looking statements.
Absolutely essential. They make it clear, as they have to, that things might not turn out exactly as projected.
Standard disclaimer, but important.
Very. They list the usual suspects: general economic ups and downs, the volatility of coal prices, which can be significant environmental regulations, especially around climate change.
Which are always evolving.
Always. Plus, operational risks, things that can go wrong at the mines. They also mention challenges in getting insurance and surety bonds, though they note rates have maybe stabilized a bit recently. Still a factor.
And global trade stuff? Tariffs.
Yep, that gets a mention too. Tariffs, trade policies. Those could definitely impact export markets for coal.
Right. One last area the report covers is mine safety, obviously critical in this industry.
Hugely important. They state their commitment to safety programs, and they operate under MSHA, the Mine Safety and Health Administration.
The federal agency that inspects mines.
Correct. The 10Q provides a summary of MSHA inspection data for the first quarter.
What does that show? Anything stand out?
Well, it lists the total number of violations cited across all their mines, different types, like S&S, which means significant and substantial. Also, orders issued, things like that.
And the proposed fines.
Yeah, the total proposed financial penalties from MSHA for Q1 were around $611,000. and it lists pending legal actions related to citations.
But the report adds context, right? Like violation numbers can vary by mine size, Inspector.
Exactly, and companies often contest these citations, so the initial proposed penalty might not be the final amount paid. It does mention a couple of mines, West Elk and Mountaineer 2, had relatively higher proposed assessments in the quarter.
So it provides some transparency, but needs interpretation.
Precisely. It's a snapshot of that regulatory interaction.
Okay, let's try to wrap this up. We've covered a lot from this Q1 report. What are the main things you think we and our listeners should take away?
Well, first, the Arch merger is obviously the dominant theme. Huge impact on revenue, market position, shifting them significantly into met coal. That's point one.
Point two, despite the revenue surge, they posted a net loss for the quarter. Higher costs, merger expenses, they played a big role there.
Right. But third, their overall financial liquidity seems quite strong, providing a good cushion.
Fourth, they're actively managing different parts of the business, leveraging the growth from the merger while also strategically handling the shrinking PRB segment.
And finally, always keep in mind the inherent risks in the coal industry. Market volatility, regulations, and their ongoing focus on safety, as reflected, in part, by that MSHA data.
So for you, the learner, digging into a report like this, it really gives you a window into the energy sector's dynamics, doesn't it?
Absolutely. You see M&A in action, you see how global markets and regulations affect a major company, it connects the dots.
Okay, here's a final thought to leave you with. We've seen this massive transformative merger. We know the energy landscape is constantly shifting. So looking ahead, what do you think are the biggest strategic challenges and maybe opportunities facing core natural resources now?
Yeah, how do they balance integrating this huge acquisition with navigating market pressures, environmental concerns, maybe even finding new paths forward?
Yeah.
Lots to think about there.
Definitely food for thought. We hope this deep dive helped make sense of Core's latest report.
And remember, if you've got a source you'd like us to tackle in a future deep dive, please send it our way. We're always looking for the next challenge.